we've had a significant repricing in treasuries and in bonds, yet I don't see credit stress in high yield and investment grades. I still see spreads really tight. Are you surprised by how resilient credit has been despite the pickup in treasury yields?
Yeah, they're really tight, Jonathan, but they have widened, to be fair. I look at the HYCDX, and they've spread out by about 10, 15 basis points. And the logic there is that high-yield companies will have to pay more for their money, and they have a substantial amount of bonds to roll or to replace when others mature. Yeah. Typically, high-yield companies issue at the 5-year area, and so in 2018, 19, and 20, they're going to be faced with narrowing spreads in terms of margins and higher yields, and so that's why it affects high-yield bonds. I think they're going to continue to widen.
I mean, I just want everybody to notice this on Bloomberg Radio and Bloomberg Television worldwide, that John Farrow there was asking a sophisticated question for his wonderful show, The Real Yield. He was
There's a shameless plug.
Of 12 noon today. I know John Farrow was doing that. I'm sorry, Bill Gross. That was way too bond-like. But what we're going to have, Bill Gross, is every month, Bill Gross, we're going to have bond prices go down. At what point does the retail investor or the smaller institutional account panic? They don't listen to you. They don't listen to your good competitors. And they're going to say, wait, bond price down, I'm getting out. How close are we to that?
Well, I think we're getting there, Tom. On a month-to-month basis, they're losing money and probably have for the last 2 or 3 months. And investors don't like to lose money. They prefer cash, right? Or even cash in a mattress, I suppose. But, it's a short period of time. I would say that bond investors should expect to earn nothing in 2018 and maybe, with a minus sign in front of it. Typically, that doesn't happen because, with higher yields in the past, it's been the yields that have compensated for the price declines. But now, in terms of going up by 20 or 30 basis points in the last month, for the 10-year, that basically implies a 2% price decline, and that requires an annual income of coupon clipping in order to compensate. So I think retail is going to be sensitive now from this point forward, certainly after this report.
Okay, that's a really important statement. Would you suggest, as being unconstrained at Janus, that dividend growth is an alternative to bond clipping to a flat or negative return this year for bond investors?
Oh, sure. Unconstrained, and certainly Janus unconstrained, can be unconstrained. And we've been, because I've been forecasting higher interest rates and lower bond prices, we've been short duration as opposed to positive duration. Typically, total return funds, are forced to monitor what's called the Barclays Aggregate Index, which has a duration of 5 or an average maturity of about 7 or 8 years. Unconstrained can go the other way. And so we've been basically a minus 2 years of duration for the last month or two, and I think you can see that in the performance. So, when you have a bear market, you want to go unconstrained because it gives you the flexibility to go minus as opposed to plus.